Throughout history, the global economy has operated under a series of dominant monetary systems, each anchored by the currency of a leading empire. These cycles follow a predictable rhythm that reflects the rise and decline of nations based on their productivity, competitiveness, and trustworthiness. When a nation becomes the world's most productive, its currency naturally rises in demand because other countries want to trade with it, invest in it, and hold its assets. This increased usage gives that currency global status, allowing its nation to borrow cheaply, project power abroad, and influence global finance. However, over time, the very success that elevates a nation's currency often plants the seeds of its decline. Excessive confidence, mounting debt, and internal complacency begin to erode the foundations of that strength, eventually leading to a loss of trust in the currency itself. The Dutch guilder was the first global reserve currency of the modern era. It became dominant in the 1600s because the Netherlands was the world's leading trading and financial power, with a highly productive economy and efficient capital markets. Amsterdam's banking system was considered revolutionary, and its currency was backed by credibility and discipline. But as Dutch influence waned, and as military and economic rivals grew stronger, the guilder's dominance declined. The British pound took its place, backed by the industrial might of the British Empire and the largest navy the world had ever seen. For more than a century, the pound symbolized stability and power. Britain's banks and insurance companies financed global trade, and the world trusted the pound as the ultimate store of value. Yet even that dominance did not last. The immense costs of 2 world wars drained Britain's finances, eroded its gold reserves, and forced the world to look for a new financial leader. That leader became the United States. After World War II, the dollar emerged as the cornerstone of global finance. The U.S. had the world's strongest economy, the most dynamic industries, and an unparalleled military presence. Its currency was backed by gold, and trust in its institutions was high. The Bretton Woods system cemented the dollar's role as the global reserve currency, allowing the U.S. to enjoy privileges similar to those of past empires: access to cheap capital, the ability to borrow in its own currency, and the power to influence global monetary policy. But as with all dominant currencies, success led to overextension. As the U.S. spent more than it earned and accumulated massive debts, the dollar's strength began to depend less on productivity and more on financial engineering. When trust starts to weaken, investors and nations begin to diversify away from the dominant currency, marking the early stages of decline. The pattern has repeated across centuries because it's driven by human nature and economic reality. Productivity, innovation, and discipline create strength. Excess, debt, and complacency destroy it. When a country's income exceeds its expenses, it builds wealth and credibility. When it consistently spends beyond its means, it borrows against the future, eroding both trust and power. At first, these imbalances seem manageable because the dominant nation can print the world's most trusted currency to fund its deficits. But eventually, that very privilege becomes a trap. The more it prints to sustain its lifestyle, the less others trust its money. Confidence fades gradually, and then suddenly, as history shows in every empire that has fallen. The story of global currencies, therefore, is not just about money. It's about the deeper forces that shape civilizations. Productivity and trust are the bedrock of financial dominance. Military might, technological leadership, and sound governance support them, but they cannot replace them. A currency's strength mirrors the moral and economic health of its nation. When societies remain industrious, disciplined, and forward-looking, their money becomes a reflection of that stability. When they drift toward division, overspending, and short-term thinking, their money loses value, and with it, their influence over the world. The U.S. dollar has long been the cornerstone of the global financial system, serving as the world's primary reserve currency and a symbol of economic stability. For decades, it provided a foundation upon which global trade, investment, and finance were built. But today, the same forces that once made the dollar strong are showing signs of strain. Excessive debt, persistent fiscal deficits, and political dysfunction are gradually eroding the confidence that has underpinned the dollar's dominance for nearly 8 decades. What made the dollar exceptional in the first place was not just the size of the U.S. economy, but the trust in its institutions, the credibility of its monetary policy, and the discipline of its financial system. As these elements weaken, the foundation of dollar supremacy begins to shift in ways that are difficult to reverse. The dollar's strength emerged from a unique set of post-war circumstances. After World War II, the U.S. possessed the largest industrial base, the deepest capital markets, and nearly two-thirds of the world's gold reserves. This combination of productivity and credibility allowed the U.S. to anchor the Bretton Woods system, linking global currencies to the dollar and the dollar to gold. It created stability and encouraged trust. But in 1971, when the U.S. abandoned the gold standard, it shifted from a discipline-based system to one driven by faith in policymakers and credit expansion. That transition gave America enormous flexibility to finance growth, wars, and innovation, but it also opened the door to the same cyclical excesses that have undone past empires. Over the decades, debt became a substitute for productivity, and financial assets grew much faster than the real economy. Today, the U.S. carries a debt burden that exceeds its annual output, with obligations rising far faster than income. Persistent fiscal deficits have become the norm, and the government's willingness to borrow without restraint has been met with complacency from markets conditioned to expect perpetual intervention by central banks. Each crisis, from the dot-com crash to the global financial crisis to the pandemic, has been met with more money creation, more debt issuance, and more reliance on artificial liquidity. While these policies have stabilized markets in the short term, they have undermined long-term trust in the currency. Every time money is printed to solve a problem, the underlying value of that money is diluted. Confidence erodes not all at once, but gradually as investors and nations begin to question whether the system is sustainable. Political polarization has deepened the problem. Economic policy in the United States has become a reflection of short-term political incentives rather than long-term strategy. The inability to agree on fiscal discipline, entitlement reform, or balanced taxation has created a structural imbalance that no central bank can permanently fix. This gridlock weakens the perception of American governance, and since trust in the dollar is inseparable from trust in the U.S. government, the currency bears the consequences. Internationally, this has led many countries to reassess their dependence on the dollar for trade, reserves, and settlement. Even allies are beginning to explore alternatives as they seek protection from the volatility of U.S. monetary and fiscal decisions. Another source of vulnerability is the dollar's weaponization in geopolitical conflicts. Sanctions, financial restrictions, and the exclusion of nations from dollar-based systems have created incentives for others to develop parallel mechanisms. What once served as a tool of American power is now accelerating efforts by rivals to bypass the dollar entirely. When the currency of the global system becomes a political instrument, it invites resistance, and that resistance, once small, can grow rapidly when combined with advances in digital payments, blockchain technology, and new regional alliances. The result is a gradual but unmistakable erosion of the dollar's monopoly on trust. The U.S. can still print money and borrow cheaply, but that privilege depends on the continued belief that the system remains stable and fair. When investors, governments, or individuals start to see persistent debt growth without corresponding productivity, the logic behind that trust begins to crumble. History shows that reserve currencies rarely collapse overnight. They fade as confidence diminishes and as alternatives become more credible. The weakening of the dollar's foundation is not merely about numbers on a balance sheet. It reflects a deeper shift in perception, a questioning of whether the system that has dominated the world since 1945 can continue to command the same level of faith it once did. The global financial landscape is no longer defined by a single dominant power. A new generation of economies, supported by technology and strategic innovation, is rapidly reshaping the way money, trade, and influence move around the world. The U.S. dollar still holds the largest share of global reserves, but its supremacy is being quietly challenged by emerging nations and new financial technologies that offer alternatives to the traditional dollar-based system. This shift is not merely about competition, it is about transformation, where economic strength, digital infrastructure, and political alignment are combining to build a more multipolar currency world. As nations seek independence from the vulnerabilities of relying on a single currency, the global order is evolving faster than most realize. The most visible driver of this change is the rise of China and other emerging economies that now command a growing share of global trade and production. China's Belt and Road Initiative, coupled with its expanding trade networks across Asia, Africa, and the Middle East, has established a foundation for currency diversification. By promoting the use of the yuan in bilateral trade settlements and developing alternative payment systems like the Cross-Border Interbank Payment System (CIPSs), China is reducing its reliance on the dollar-dominated STUFT network. This strategy, though gradual, is gaining traction as more countries begin to see value in using local or regional currencies to settle trade. Each transaction conducted outside the dollar system weakens its network effect and reinforces the idea that global commerce no longer needs a single monetary anchor. At the same time, digital currencies, both public and private, are accelerating the transition. Central bank digital currencies, CBDCs, are now being developed or tested by more than 100 countries, with some already in circulation. These new forms of money allow direct settlements between nations, bypassing traditional banking channels that are heavily dollar-dependent. Blockchain technology has made it possible to transfer value across borders instantly and securely, challenging the efficiency and exclusivity of the USA-led system. Even private innovations such as stablecoins and decentralized finance are introducing new layers of competition, offering liquidity and exchange mechanisms that operate independently of central authority. In this environment, the monopoly of trust that once defined the dollar is being replaced by a network of digital and regional systems that share power more evenly. Energy and commodity markets are also playing a crucial role in this shift. For decades, global oil trade was conducted almost exclusively in dollars, reinforcing the so-called petrodollar system. But now, new agreements between major producers and importers, particularly those involving China, Russia, and the Gulf states, are breaking from that tradition. Deals denominated in yuan, rubles, or even digital currencies are becoming more common, signaling a willingness to diversify financial exposure. When nations controlling the world's critical resources begin settling trade outside the dollar, the psychological and practical foundations of its dominance start to weaken. This process does not happen overnight, but it builds momentum as more participants find stability and mutual benefit in alternatives. Underlying all of this is a deep desire for financial sovereignty. Many countries have grown uneasy with a system that allows one nation to effectively control global liquidity and payment channels. Sanctions, asset freezes, and political leverage have made it clear that dependence on a single currency carries risks that extend beyond economics. The creation of regional trading blocs, the rise of alternative financial institutions like the Asian Infrastructure Investment Bank, and the cooperation among BRICS nations are all symptoms of a world seeking balance. The global economy is becoming increasingly interdependent, yet it is also more fragmented in its financial architecture. The new era of currency competition is not about replacing one empire with another, it is about decentralization. Economic power is spreading across multiple centers, and with it, the mechanisms of trade and finance are adapting. Nations that once followed the rules of a dollar-based system are now writing their own. They are building regional frameworks, investing in digital resilience, and aligning their monetary strategies with long-term national goals rather than global dependency. As these initiatives mature, they create an ecosystem where no single currency can dominate without accountability. The resulting world order will be less predictable but more balanced, shaped by cooperation among several strong players instead of control by one. The acceleration of global change today is unlike anything seen in previous centuries because several powerful forces, debt, technology, and geopolitics, are converging simultaneously. Each of these forces alone has the capacity to reshape economies, but together they are compounding one another, compressing time and amplifying impact. What once unfolded gradually over decades is now happening within a few short years. The result is a rapidly shifting global financial order where traditional assumptions about stability, growth, and monetary dominance no longer hold true. The rhythm of change has quickened, and the systems that govern global finance are being forced to adapt in real time. The debt cycle is the most dominant driver of this transformation. Throughout history, nations have risen and fallen based on how they manage their borrowing and spending. Debt, when used productively, can fuel innovation, infrastructure, and long-term growth. But when it becomes excessive, when it's used to sustain consumption rather than productivity, it leads to instability. The world has now entered a phase of debt saturation, where both governments and private sectors depend heavily on credit expansion to maintain economic activity. The US, Europe, Japan, and even emerging markets have all reached levels of debt that exceed what their economies can sustainably support. Central banks have responded with unprecedented money creation, driving interest rates to historic lows and flooding the system with liquidity. Yet the more liquidity is created, the less effective it becomes, because each new dollar produces diminishing returns in real growth. This erosion of monetary effectiveness marks the late stage of a debt cycle, where confidence in paper money starts to weaken and investors seek alternatives that hold real value. At the same time, technology is compressing economic timeframes. Innovations that once took decades to reshape industries now do so in a matter of years. Digitalization, automation, and artificial intelligence are disrupting labor markets, altering supply chains, and creating new forms of wealth and inequality. The financial system itself is being transformed by technology. Digital payment systems, blockchain, and tokenized assets are challenging the traditional banking model. These technologies allow individuals, corporations, and even nations to move capital directly, often outside the oversight of central authorities. As financial intermediation becomes more decentralized, the ability of traditional powers to control capital flows diminishes. This democratization of finance is empowering new players, especially in emerging economies that can leapfrog old infrastructures entirely. The pace of technological adoption means the monetary order can shift far faster than previous generations ever imagined, and those who fail to adapt risk becoming obsolete almost overnight. Layered onto these economic and technological shifts are intensifying geopolitical tensions. The world is moving from an era of relative cooperation to one of fragmentation and competition. Major powers are increasingly pursuing their own interests rather than global consensus. Trade wars, resource rivalries, and territorial disputes are redefining alliances and reshaping global supply chains. Each conflict or rivalry accelerates the desire of nations to insulate themselves from vulnerability, particularly financial vulnerability tied to dependence on a single global system. This geopolitical realignment feeds directly into the currency shift. Nations under pressure from sanctions or political confrontation are developing alternative systems to settle trade, store reserves, and secure assets. These parallel financial structures weaken the dominance of any one currency and contribute to a more multipolar financial environment. The convergence of these three forces, unsustainable debt, disruptive technology, and geopolitical fragmentation, is what makes this moment different. In the past, changes in monetary order followed long cycles of accumulation and decay. Now, these cycles are overlapping. The excess of debt is meeting the speed of technological disruption and the instability of political division. This combination accelerates every outcome. Both positive and negative innovations that could stabilize the system are adopted quickly, but so are crises that can destabilize it. What took decades to build can now unravel in months when confidence breaks or new technology exposes inefficiencies. This is why the current transition feels so rapid and unpredictable. The financial order is no longer governed by a single set of policies or principles. It is being redefined by a collision of economic necessity, technological possibility, and political will. Adapting to a changing global order requires a complete shift in mindset. The world that once rewarded passive stability and trust in traditional systems now rewards flexibility, diversification, and foresight. Success in this environment depends not on predicting the future with precision, but on preparing for a range of possible outcomes. As the financial order transitions from a unipolar to a multipolar structure, those who cling to the past will find themselves increasingly exposed, while those who think globally and act adaptively will capture new opportunities. The most powerful advantage today is the ability to anticipate change before it becomes obvious and to adjust one's position accordingly. For decades, investors, institutions, and governments could operate under a set of predictable rules. The US dollar-dominated global trade flowed through well-defined systems, and central banks acted as reliable backstops to stabilize shocks. That predictability bred a sense of comfort that often led to complacency. But now, volatility is structural, not cyclical. Currency fluctuations, shifting trade alignments, and rapid technological innovation mean that the old playbooks no longer apply. Diversification across assets, currencies, and geographies is no longer a luxury, it is a necessity. Those who continue to rely on a single currency, a single market, or a single policy framework are effectively betting against history. Every major power and every dominant currency has eventually faced decline, and those who failed to adapt to those transitions suffered the greatest losses. Thinking globally is not just about investing in multiple regions, it's about understanding how interconnected the world has become. Supply chains, data networks, and financial systems now transcend borders. A disruption in one part of the world can ripple through markets within hours. This interconnectedness creates both risk and opportunity. It rewards those who can read the global pulse, those who understand that wealth is no longer confined by geography, but influenced by global cycles of capital, productivity, and innovation. To succeed, individuals and institutions must develop a perspective that sees beyond their own borders and recognizes how changes in interest rates, policy decisions, and geopolitical tensions interact on a worldwide scale. Adaptability is also psychological. It demands a willingness to question old beliefs and challenge comforting assumptions. For many, it is difficult to imagine a world where the systems they grew up trusting are no longer dominant. Yet that is precisely what history teaches us to expect. Every empire, every economic order has believed in its permanence until the moment it began to crumble. The winners of each transition were not those with the most resources, but those with the greatest flexibility of thought. Adaptability means building strategies that can survive both prosperity and crisis, strategies that are not dependent on any single scenario but are resilient across many. It means holding assets that preserve value when currencies fluctuate, understanding industries that thrive on innovation rather than debt, and aligning with trends that reflect real productivity rather than speculation. In a world defined by rapid change, decision-making speed becomes as important as accuracy. The ability to act before consensus forms is a key differentiator between those who lead and those who follow. This applies not only to investors but to nations and corporations as well. Countries that reform their systems, balance their budgets, and invest in education, technology, and infrastructure before a crisis hits will emerge stronger. Companies that embrace automation, sustainability, and global integration will outlast those that cling to outdated models. Individuals who continuously learn, adapt their skills, and think independently will maintain relevance even as industries transform. At its core, adaptability is about humility, the understanding that no system, no currency, and no nation is immune to change. The greatest danger in times of transition is overconfidence in the status quo. The institutions that endure are those built on the recognition that everything moves in cycles, that every period of dominance eventually gives way to renewal elsewhere. In a multipolar world, power and prosperity will flow to those who remain open-minded, well-diversified, and responsive to signals of change. The future global order will not be determined by who can print the most money or accumulate the most debt, but by who can create genuine value and maintain internal strength amid instability. Real value comes from productivity, innovation, and trust, three elements that have always separated rising powers from declining ones. Throughout history, civilizations that invested in education, technology, and disciplined governance built enduring prosperity, while those that pursued short-term gains through money creation and political manipulation eventually weakened from within. The same principle applies to individuals, corporations, and nations today. When the foundation of value creation is strong, external shocks can be absorbed. When it is weak, even minor disruptions can trigger collapse. The next world order will reward those who focus on substance over illusion, strength over stimulus, and long-term capacity over short-term comfort. Productivity remains the most powerful driver of wealth. A country or business that consistently produces more value than it consumes builds resilience. This requires investment in human capital, innovation, and systems that encourage efficiency rather than speculation. When productivity rises, debt can be sustained. When it stagnates, debt becomes a burden. In the past few decades, much of global growth has been financed through borrowing rather than real output expansion. This has created the illusion of prosperity while masking structural weaknesses. As the debt cycle matures and money creation loses its effectiveness, the world is being forced back toward fundamentals. Nations that can produce real goods, control essential resources, and innovate in emerging industries will regain influence, while those dependent on financial engineering will find their leverage diminishing. Trust is another pillar that will define strength in the new order. Trust is earned through transparency, discipline, and consistent policy. It cannot be decreed or manufactured. A currency is only as strong as the belief that others have in its issuer stability and fairness. When governments prioritize long-term responsibility over political expedience, they reinforce that trust. When they manipulate data, overpromise, or weaponize their currency for short-term gain, they erode it. The erosion of trust in major financial systems is one of the central reasons the world is moving toward diversification. People and nations seek alternatives not only because they want better returns, but because they no longer believe that existing systems will remain fair or sustainable. Rebuilding trust requires sound governance, accountability, and a demonstrated commitment to balancing ambition with prudence. Internal strength goes beyond economics. It reflects a nation's ability to stay unified and functional under stress. Historically, great powers have fallen not just because of external competition, but because of internal division. Political polarization, social inequality, and declining institutional integrity eat away at the cohesion that supports stability. When societies lose their shared purpose, they become vulnerable to external shocks and manipulation. Economic resilience depends on social harmony as much as on fiscal management. A strong country is one that can debate without fracturing, reform without breaking, and adapt without losing identity. The societies that will thrive in the coming order are those that can manage transition with unity, that can innovate while preserving balance, and that can evolve without self-destruction. In the next era, credibility will replace coercion as the main currency of power. The nations and companies that demonstrate competence, fairness, and productivity will attract investment, talent, and influence. Those that rely on manipulation or financial excess will lose relevance. The global system is entering a phase of accountability where actions will have immediate consequences and where reputation will determine access to capital and opportunity. Strength will no longer be measured by the size of balance sheets alone, but by the quality of systems that convert potential into progress. This shift represents a return to fundamentals that have always governed human advancement. Prosperity, whether for nations or individuals, comes from creating more than one consumes, maintaining integrity, and preparing for inevitable cycles of change. As the global order evolves, the true winners will not be those who resist the transformation, but those who embody resilience through productivity, adaptability, and trustworthiness. Those qualities, not privilege or policy, will decide who leads in the world that is now taking shape.